from the Newmarket Business Association. Delighted to welcome you along with my colleague Cheryl Adamson from the Parnell Business Association. So welcome all of our Newmarket and Parnell members to this, our first joint webinar for 2022. Happy New Year, although it's a bit late to say that. Happy Chinese New Year as well. For those, yesterday was the first of the Chinese New Year celebrations. We are delighted again to welcome Cameron Bagrie to join us to give us an update on what really is going on. I mean, at the moment, it seems to be everything's all over the place. And Cam has kindly agreed once again to share some insights for us onto what to look for, well, what's going to happen in the year ahead potentially, and whether we should be bracing for impact. And I won't talk any further. We'll have some. If you've got any questions, please put them in the chat side of the screen, and we'll have a few questions at the end. But Cam, over to you.
All right, thanks, Marcus. Thinking about a catchphrase for 2022, and the catchphrase that keeps on popping into my mind is what I call the 3 R's. And the 3 R's are reality, reset, and some real hard work. And I guess if you look at a variable that sort of connects all the dots between the 3 of those, it's this variable called inflation. And what we've got across New Zealand at the moment is an awful lot of it. It's popped. It's not just reflecting COVID, it reflects a fundamental mismatch between demand and supply. That the economy has exceeded all expectations, which has been a good thing. There's a nasty byproduct of that success, and it's called inflation, and the Reserve Bank is now going to be on a warpath to go try to get the inflation genie back in the bottle. And unfortunately, getting inflation back in the bottle was not what you would call growth friendly, because you're going to come out and start waving that big interest rate stick more and more. And we're starting to see globally at the moment some pretty clear signs that the asset price cycle has turned. So equities in America, depending on what you look at, Dow Jones Industrial Average, S&P 500 down 5 to 6% in January, NASDAQ down double digits. Starting to hear a lot more stories in New Zealand about the property market cycle turning as well. Considering how asset prices have performed in the last sort of 2 years, you're giving back a bit of those gains is going to feel like a little bit of a drop in the bucket. But no illusions. We're going through that reset, a bit of a reality check now in regard to what's going on. There's no free lunch when you inject a whole lot of money into the economy and take interest rates down to record lows. You're always going to see something that pops, gives you a nasty surprise, and it's inflation. And we're going to get some really good labour market figures in about 40 minutes, which are going to show the unemployment rate in the low 3s. That's another really good economic story. Pat on the back. Of course, what we're also seeing out there is that when you can't find skilled staff, well, the wage line starts to go through the roof. So every sign of success has another story on the other side. But what I pulled together today, I've pulled together about 12 bigger picture themes or things that I'm keeping an eye on at the moment. Theme 1 is just the mood of the nation. I keep a pretty close eye on the Ipsos issues monitor, which gives us an idea between both the economic and the social ledger. And social issues, housing, healthcare, poverty, inflation have been sort of top of the pops for consistently a long time. Now we're going to get an updated read on this in the coming 4 weeks, sometime in February. The 2 ones that I'm going to be looking at pretty closely are the movement in variable 3, which is inflation, the cost of living. I suspect that is going to escalate as a concern for society, as we've seen inflation head to 5.9%, and it looks like it's going to head through 6%. The other one that I'm keeping a pretty close eye on at the moment, and it's often taken for granted, is crime, law and order. We are seeing a lot more crime activity across New Zealand, and the thin blue line is definitely becoming the thin blue line. Some of it's these 501s that are coming back to New Zealand, but out of an economic success story, we've still got deteriorating social indicators. So unemployment rate, 3%, are going to be in the low 3s. There's another 50,000 people on a benefit than what there was pre-COVID. Now that is an eye-watering increase in benefit dependency in the last 2 years. Theme 2 is still that old sort of story in regard to disruption. Omicron is just another layer of disruption. Go talk to anybody in Northland about weather patterns. or the weather bomb that looks like it's coming through New Zealand over the weekend. Staff is becoming more and more of an issue. It's not just finding staff, it's getting them regularly turning up. We're now starting to see this thing called a backward sloping supply curve. And this is what takes place in some areas, is that the more money people get paid in regard to wages, the fewer hours they actually want to work. Now, the normal relationship is that you pay people more, you expect them to actually turn up and want to actually make more money. Now, for certain parts of society, no, it actually works in reverse. They want to work even less. Government policy is having a massive impact, particularly of late. The triple CFA, new legislation, which has tightened down the screws in regard to credit availability, is anecdotally having a real big impact on the ground. Obviously, ESG. The one on the right-hand side is China. I put up the Evergrande. China's our biggest trading partner, and there's a lot going on within the Chinese property market at the moment, and it's going to pay to keep an eye on the Chinese property market, particularly as the US Federal Reserve hike rates. The US Federal Reserve is the most powerful central bank around the globe, and monetary policy in China is effectively dictated by what happens in good old Uncle Sam and the US Federal Reserve. And we're seeing growing expectations at the moment that the US Federal Reserve is going to be lifting interest rates over the coming 12 months. We think we've got an inflation problem at 5.9%. US inflation is at 7%. And it's one of the reasons, as those expectations have started to mount, they're going to be lifting interest rates. We've started to see global asset prices have started to look wobbly over the month of January. Theme 3 is finding staff. As I said, we're going to get some numbers in about 40 minutes, which are going to be absolutely stunning. Really good news story in regard to record low levels of unemployment. But you just need to look at other economic indicators such as seek job ads. You seek job ads bouncing around a little bit, but if you look at the overall index number, absolutely levels we've not seen before. Where we're seeing the biggest surge in job ads across New Zealand is actually not in the main city centres, it's out in the regions. It's your Gisbornes, it's your Hawke's Bays, is where they can't get staff, particularly across the farming sector in New Zealand. Now, out of this, strength in job ads, doesn't matter what economic indicator you look at, whether it be finding skilled staff, labour availability, the physical unemployment rate, the labour underutilisation rate, we've got really acute shortages, and people are now starting to throw around this term called the Great Resignation. All power to the worker, so to speak. Well, there's another sort of spin on the Great Resignation. What if what we're going through at the moment is a massive pendulum shift back to the workers? If you look at what's called labour share of GDP, compensation of employees, in most countries around the globe, it's been declining for the last sort of 30 odd years. It's been reflected globalisation, technology, diminished wage bargaining power of unions. Now, I think some of what's going on at the moment is a pretty tectonic shift where, courtesy of shift in attitudes, or also just labour availability and population ageing, because labour scarcity, I think, is going to be an issue for the next sort of 20 to 30 years. And we haven't been underinvesting in people training, we have been underinvesting in people in training for a long time. We've been reliant upon importing capital via that migration lever. Well, every country is going to want scarce migrants over the coming 20 to 30 years to help pay for the baby boomers. But one of the dynamics that I'm thinking about here at the moment is that, what if the Great Resignation is a lot more permanent? What does it mean for employers in regard to making sure that you're top of the pile? And I go back to when I first joined the banking sector. We were taught by Sir John Anderson, look after your staff because the staff looked after the customer. If the customer's looked after, we're going to make money. And somehow banking sort of reversed that order over the next sort of 20 to 30 years. It became all about the shareholder and less about people. What we're now starting to see around the globe is that we're going back to that primary order where people look after the customer is looked after, where you're going to make money. But it's a fundamental shift, move away from what's called shareholder capitalism towards what's called stakeholder capitalism. And at the epicenter of stakeholder capitalism is just looking after your staff. Now, I said today we're going to get a record low unemployment number. If you look at the number of people on the benefit, it tells you a completely different story. In the past 2 years, there's been a 54,000 increase in the number of people on all benefits, and 48,000 of those have been on a benefit of more than a year. Now that's telling you a structural dependency story. So yes, let's take the glass half full. The Household Labour Force survey numbers we're going to get today will show a very good number. The welfare dependency statistics that I'm seeing at the moment, like if you work out the maths, you have 360 odd thousand people on a benefit today. That is 1 people of working age in 9 is on a benefit. Now, those sort of figures are pretty eye-watering. And of course, you get that sort of rising benefit dependency, you're going to start to see the ancillary consequences coming through in regard to problems in regard to law and order. Omicron, we can't get through an economic presentation at the moment without looking at what's going on. Foot traffic we're seeing around the country is down about 20%. Transaction volumes are down as well, but it looks like when people are out to spend, they're actually more inclined to spend when they're out shopping. So less shopping in regard to frequency, but spend more when they're out. So the upper end is tending to take a little bit more of that wallet. I saw, in fact, I've got a chart later on which shows Michael Hill exceeding expectations in the warehouse, coming a little bit short. The big thing to realise in regard to Omicron is the nature of the shock. Now, if you look at COVID Delta, it was a price shock through commodities, imports, consumer goods. There was supply chain disruption, which was partly labour related, but the labour relation was it was a secondary channel that sort of impacted the primary channel. If you look at Omicron, it is a price shock that's going to come through the labour market as people have to self-isolate. People are not turning up to work at a time the labour market is already under intense pressure. Now, one of the things that worries me at the moment, just going back and thinking about that social ledger, what if we go through what happens with Australia and we start to see supermarket shelves empty? Now you've got a recipe for a massive collision here and a little bit of nastiness on the ground. I'm keeping a real close eye on the likes of commodity prices. There's a lot going on up in the Ukraine, Russia, these sort of places. It looks like we could see a spike in gas prices. What happens to oil prices is anybody sort of guess, but the more Omicron spreads around the globe and feeds into labour market availability, the more you are going to see goods availability, or the more you are going to start to see pressure on certain commodities, just to lift, and people will pay, particularly for some essentials. Theme 5, economists, we tend to talk an awful lot about demand. What's happening within retail sales from quarter to quarter, business confidence, building consents, these sort of things. Ultimately, supply is the more important line. It's your ability to meet demand. And there's a couple of things in regard to demand, supply. We call that potential growth. Potential growth is a combination of productivity growth and labour availability and the efficiency of capital. Now, in a COVID world, labour is not as efficient, and we've got labour scarcity to deal with. So one of the things I'm trying to get my head around at the moment is that what is the slope of potential growth? How fast can the New Zealand economy grow in a post-COVID world? And I don't think it's as fast as what it was in a pre-COVID world. Treasury seems to think so. But if we're in a slower growth trajectory because managing COVID, Omicron-related risks, we can't get labour into the country, so we get all these supply bottlenecks that hold up, it has real strong inflationary consequences. And it actually means that unless we can get supply side capacity up, there's going to be a lot more inflationary pressure in the system, and central banks around the globe, including the Reserve Bank, have got a lot more of the job on their hands. I call 2022 sort of a year of the reset in reality, partly because we've got the mechanism, we've got the means to stimulate demand. You can cut interest rates, you can print money, the government just goes out there and spends a whole lot of cash. Now, ultimately, the most important line out there across the economy is the ability to meet demand. It's like the 1,500 metre race. Demand is like the first 400 metres to sprint. Well, the race is ultimately how you run the 4 laps as opposed to the first lap. It's what you're doing year after year consistently. And this is where we need to evolve. We need to shift as a country away from the sugar candy sort of stuff towards delivering policies that are going to make a difference in regard to managing risk and particularly making labour more available. And this is where the OECD came out yesterday actually and basically told the government, spend less. Focus a lot more on that supply stuff, because ultimately that is the line that is going to make the difference year after year. Theme 6 is inflation. I've got inflation going to in excess of 6% in the next quarter, and then hopefully coming down slightly in the back half of 2022 as we see the big September quarter number pop out of the annual rate. Now, that is very conditional. But if you ever look at what we've got at the moment in regard to inflation, there's 3 legs. There's one, the supply problems. So higher freight costs, and it's not just getting stuff into the country. Have a look at the price of diesel. The price of diesel is up 40% on the start of 2021. That is one hell of a shock. You've got excess demand. So you've got low unemployment, you've got rapidly rising wages, and we've had a big surge in asset prices. So you've got a pretty good environment for demand for people to get there and spend money. But you've got excess demand amidst constrained supply. And then we've got a few structural problems, challenges, which all up, to me, suggest we could have a bit of an inflation problem on our hand. And this is the nightmare scenario for the Reserve Bank in regard to what they need to handle going forward. I think inflation is going to spike again in Q1. Partly is we're now starting to see consistent price increases. I think the retail sector, Greg Halford come out there with a survey the other day. But when you see diesel prices up 40% in 12 months, well, you're going to start to see price rises across the board through the transport system. So it's not just getting containers into the country where we know they're a lot more expensive. But if I have a look at people are asking me, could inflation go to 7%? Well, the short answer is maybe. It would actually need a bit of a one-off increase in fuel. Now, let's assume fuel prices remain at current levels over the March quarter. Well, fuel prices are still going to be 5% higher than where they were in the December quarter on average. Will that be enough to get us to 7%? The answer is no. But if we see, you go have a look at the New Zealand dollar at the moment. Now, the New Zealand dollar at the moment was down the other week, 2.4% a week, and it's down 4% in 2 weeks. Now, a big reason the New Zealand dollar is down is that because people have repriced what's called the US Federal Reserve. So as at the 1st of December 2021, there were expectations the US Federal Reserve might lift interest rates 3 times over 2022. As of a couple of days ago, the expectations are the US Federal Reserve could be lifting their federal funds rate anything from 4 to 5 times. So currencies are two-sided coins. And what we're seeing at the moment, as inflation becomes a lot more of a global phenomenon, it's not just New Zealand that's got a bit of a problem here. You're starting to see the New Zealand dollar that's coming under a little bit of pressure. Now, that's a really good story for some parts of New Zealand, i.e. the rural community. You go and talk to anybody on a dairy farm at the moment, it's absolutely Christmas. You've got high commodity prices and global dairy trade prices were up another 4% overnight, and got a New Zealand dollar that as of this morning is back slightly up above 66 cents. The 66 cents, given where commodity prices are, looks pretty cheap. Now, unfortunately, the 66 cents, it's not what you call exactly friendly for the retail sector across New Zealand, and it is going to put pressure on fuel prices to pop up, and rising fuel prices are not retail friendly. There's still a whole lot of inflation suppressants out there. There's also some structural shifts that I'm keeping an eye on. There's more pressure to produce stuff now locally. You manage that supply chain risk by producing it within your own country. Now, there is a cost to pay for that because it's not as efficient as importing it from other countries around the globe. We are seeing very strong shifting labour dynamics. I talked about the Great Resignation as potentially being a little bit more than that, a fundamental pendulum shift towards the workers. Yeah, so, and what we're now starting to see is a lot more chatter, talk across the market in regard to what wage increases need to be to keep up with inflation. Well, we're going to see some labour cost numbers today, which will show accelerating wage inflation, but it's going to show wage inflation still well below 6%. In fact, it'll be less than half that. But what you're going to start to see within demands going forward is, the CPI inflation is going to be a huge driver of wage bargaining outcomes. Climate change, we know we need to address it. Well, climate change carries a cost. The price of stuff goes up. Carbon costs, etc., ETS, all these sort of things. Well, someone's going to end up paying for it. Demographics. I'm going to talk in a second about what if the bucket list now starts with the letter F and not the letter B, because the baby boomers are now getting out there and starting to spend. And the baby boomers, they don't think are going to be interest rate sensitive. So they could take a little bit of reining in. And we're now entering an era of what we call government dominance, which is the fancy way of saying governments around the globe, I think, are going to keep spending willy-nilly. And they're going to make it pretty tough for central banks to actually get inflationary genie back in the bottle. Theme 7, the OECD was out yesterday, so just drew a bit of a snapshot in regard to what they said within that report. There was the obvious stuff: raise ICU capacity, withdraw fiscal stimulus rapidly, which is just a fancy way of saying stop spending as much. But if you look at the 2022 budget, it's going to be a big spending budget based on what they said at the half-year economic and fiscal update. Commit to a long-term debt target. At the moment, they're saying we're just going to keep debt levels at prudent levels. Now, what's prudent is anybody's sort of guess. We'd like to see a little bit more specifics in there, so it provides a bit of an anchor. Raise the age of pension eligibility. We've got a structural problem in New Zealand that, if left unchecked, government debt is going to go to 150% of GDP because of the fiscal cost of an ageing population. And it's not just NZS, the big balloon variable is health. Strategically within my own portfolios at the moment, I'm trying to get a lot more exposure to the health sector because the numbers are pretty astronomical on what the demand is going to be going through. Remove barriers to entry in the grocery sector. And after that, the Commerce Commission is going to be looking at the building industry in 2022. And I wouldn't be surprised to have a look at competition in the banking sector in 2023. They talked about giving councils a share of GST to accommodate growth. Regions around New Zealand, the likes of the Auckland Council, they're just cash constrained. And the only way we're going to get around that is, as the OECD states, you've got to start to divvy up some of the GST, advance the national digitalisation strategy, and within that, there were some quite pointed comments about improving science and mathematics teaching, particularly in primary schools. One of the big indicators I ever look at for where New Zealand is going to be 30 years down the track is what's happening within primary schools, because the level of attainment in primary schools today, eventually the workforce of 30 years down the track. If we're not improving their achievement, their attainment levels in primary schools today, then we've got a ticking bomb 20 to 30 years down the track. So it was really nice to see the OECD come out with some specific comments and behind that some recommendations as well. Theme 8, I talked about, what if the bucket list now starts with the letter F and not a B? The F version just sort of personifies this whole idea that it's a little bit of Freddie Mercury. I want it all and I want it now. And having the financial firepower to go out there and do it. So if we have a look at, there has been an additional $700 to $800 billion worth of wealth has been put in households' pockets in the last 2 years. That is absolutely off the charts. Now, what's called the wealth effect on spending, it's about 3 cents in every dollar. So 3 cents of 800 billion, there's $24 billion worth of pipeline spending into the retail sector in New Zealand. And this is one of the big reasons you're seeing motor vehicle sales, you're seeing jet skis, you're seeing E-bikes, expensive golf clubs are absolutely flying out the door. People have just made so much money out of this wealth effect. And, Omicron, Delta, COVID means you can't travel. You can't travel, so there's another $10 billion that's been ploughed back into the domestic economy. And it's not going into the tourism sector. The tourism sector, I look at the tourism satellite account, and the tourism sector domestically has got about $1.5 billion of that reorientated international domestic spend. What's happened, it's just been sunk into other parts of the New Zealand economy, whether it be direct retailing, whether it be the bank of mum and dad helping out their kids or other family members get on the property ladder. But the way I'm thinking about the bucket list with an F version is that, look, even if asset prices pull back 10%, so let's say instead of making 800 billion, people are only $700 billion wealthier. $700 billion is still an eye-watering amount of money increase in wealth. And for a lot of people, that has literally set themselves up in retirement. There's a whole lot of other people across New Zealand at the moment, because the poverty statistics are pretty bad, that have not eaten like this or bought into this property sort of trade. But I'm looking at this economically. And one of the things that worries me is that what if this wealth effect takes a fair bit of taming? And what it means is that potentially the Reserve Bank has got to go even harder to bludgeon other parts of the economy to get aggregate inflation down. Now, inflation is a very simple variable, right? Inflation, to cool demand, you're going to have to turn the property cycle. The construction cost inflation is running at 16%. To get non-tradable domestic inflation down, you have to turn the property market. There is no other way to get inflation back sub 3%. So watch out in regard to what we could see in the next 12 to 24 months. But looking at that bucket list with an F, you got a whole lot of baby boomers that have made a whole lot of cash. And they've literally set themselves up. They've got a lot of money to deploy within their retirement. Theme 9, what I'm seeing out there at the moment is tighter housing credit. And it looks like every mortgage broker is out there across New Zealand at the moment pointing the finger at the CCCFA, new legislation. Well, there's actually an awful lot more going on across the property market. Tighter loan-to-value ratio restrictions. Some banks are applying debt serviceability restrictions. You've got rising test interest rates. Banks' perception of risk is a lot higher at the moment, so they're backing off. But people are just saying, look, we need to fix the CCCFA because that will let the credit wheels turn a little bit faster. Well, what we've seen in the past 2 to 3 years, if you look at the monthly change in home lending, is not normal. It is not normal for home lending growth to grow up 32 billion in 12 months or 10.5% on a year ago. What's normal for lending growth is in line with income growth. Now, let's say income growth is around 6%. Now, that means lending growth should be around 18 to 20 billion, not the 30-odd billion that has been dished into the New Zealand economy in the last 12 months. So there's a whole lot of bigger picture issues towards a CCCFA and banks' interpretation. But you've got to sit back and look at the bigger picture. Well, the bigger picture here is that we've been through an exceptional environment for the past 2 years, whether you look at the property market or whether you look at credit growth. It is not normal to see monthly credit growth of $2.6, $2.7 billion every month. So while people are pointing the finger at the CCCFA as a reason we've now got problems, look at the bigger picture. The bigger picture is saying credit growth is going to ease. And it's a big part of a turn of the property cycle. Theme 10 is just the shifting fundamentals for the property market. We're now starting to see rental yields are popping down below the cost of capital, which is, by proxy by long-term bond yields. Last time we saw that was 2008, 2009. And what we're also seeing is that the fundamentals, housing demand versus supply, have fundamentally shifted. So You go back pre-COVID, New Zealand's population growth was 90,000 a year. You had 30,000 natural, 60,000 from migration. Migration is now negative, and natural population growth is now 30,000. At the same time, building consents are 50,000. Auckland's population shrunk in the last 12 months, and Auckland has issued 20,000 building consents. Now, that subject to the lag between consent and getting that place built, because we know material accessibility is a big issue at the moment, the fundamentals of the market have fundamentally shifted. Anecdotally, there's a lot more stock coming on the market in February and March, and I think we're going to start to see the market pull back. Now, I'm not afraid of that. I think the market could be down 5 to 10%. Now, within the context of how the property market has performed in the past 2 years, it's a bit of a drop in the bucket. But of course, for retailing, retailing is driven in part by that wealth effect. And asset prices have a pretty big impact on the psyche. Just be mindful that the fundamentals have shifted. I'm also keeping a pretty close eye on what's called intra-regional migration. So Auckland in the past 3 years has lost around 35,000 people into the regions. It got masked in 2019 because we still had booming net migration from around the globe. But 35,000 into the regions out of Auckland is like the population the size of Gisborne packing up and going living somewhere else. Now, this is Gisborne, it's Hamilton, it's Tauranga, it's Northland. We're now starting to see it become a lot more widespread. Canterbury seems to be pretty popular at the moment, Christchurch. Why? Housing affordability. But I'm going to keep a close eye on these trends over 2022, because Auckland's got a bit of it's got a lot of positive attributes about it. And over time, you will see rural to urban drift into the cities. But we could see, I suspect, a reverse of that over the next sort of 2 years. And it's going to be driven by some COVID-related unease. I do not like the crime statistics or these reporting we've seen in regard to regular shootings that are coming through Auckland time and time again. And of course, housing, valuations in regard to property, there's just a big driver in regard to where people can actually afford to get on the property ladder. We're seeing little places across New Zealand, such as Wanganui, are going absolutely ballistic. Now, 5 years ago, no one wanted to live in Wanganui. Well, when no one wants to live there, the property's an awful lot cheaper. So the message here is that you see these swings and roundabouts, and it just looks like Auckland's going to be the one that suffers, I suspect, for the next sort of 12 to 24 months. And this is where I think there needs to be a big sense of urgency within some of the political arena in regard to issues such as crime, law and order. Because if we do not get these sort of things right, it is going to manifest through these sort of internal migration numbers in regard to people going and living somewhere else. And once again, this goes back to, politicians tend to think about a whole lot of the bigger picture sort of things, i.e. housing. But the ones that they're missing at the moment is that the pressure that's going on society from the cost of living, or what we're now starting to see in regard to criminal activity, particularly in the likes of Auckland. Theme 11 is just the economy. Look, there's a whole lot of good news stories still out there. There's still pent up demand. There's a lot of cash. I look at transaction savings balances within the bank numbers we see. People are sitting on a whole lot of money. As I said, we're going to get a figure out in the next 15 minutes. Low unemployment, rising wages, your really good environment. Commodity prices are booming. Go over talk to any dairy farmer. In fact, go over talk to any farmer just about in regard to what they're seeing on the ground. The exception's probably horticulture. Horticulture is going to have a few problems, I think, getting the fruit off this season. It was bad last year. I suspect this season is going to be even worse because Omicron is going to hit just at the time they're going to need people to be ripping the fruit off the trees. The concerns is obviously Omicron, the enduring impact. It is a supply shock like no other. Now, if you get sugar candy economics, Omicron is not good. So it does not make us wealthier over the next 5 to 10 years. The sugar candy gives a bit of a temporary reprieve, but it is a negative supply shock that will manifest over the next sort of 2 to 3 years through that resetting and that reality. The disruptions to supply chains, the primary avenue is going to be labour, and indirectly that is going to be materials. And it's going to make, I suspect, 2021 and 20 look like a bit of a walk in the park. Inflation is the pop variable. That is the reality check. You know, demand, supply. Yeah, demand's the sugar candy line, supply is the reality line. Yeah, we're going to either have to batten down the hatches in regard to demand, or we can start having some real hard debates across New Zealand in regard to what do we need to do to boost supply. Now, let's start asking some of those hard questions in regard to dependency. The OECD came out yesterday as well and talked about housing-related risks. I call that deteriorating fundamentals. Interesting chart they had within their report. If house prices are flat for the next 8 years, house prices will still be more expensive than what they were pre-COVID. Now that sort of puts a little bit of a context over what has happened in the last 2 years, or what we could be facing for a very long time to restore some degree of affordability into the property market in New Zealand. In terms of the economy, I'm seeing a lot more signals in regard to what's called the K-shaped recovery. Just one I grabbed was, Micah Hill issued an upgrade pre-Christmas, so the share price went up. Conversely, Warehouse didn't hit their numbers, so the share price was down 10% or 10 to 15% within the space of 48 hours. So what we're seeing out there at the moment is more and more of those K-shaped anecdotes. There is money, liquidity within the economy at the moment to extract out of people's wallets. But once again, if I go back to the stuff I'm seeing on the ground, foot traffic well down, but average spend well up. So money is still able to be extracted if you pitch and think of things through a fundamentally different level. Theme 12, the final theme, is just some fundamental pivots that I think we need to make. Demand management is easy. The foundations of growth is supply. It's meeting demand. It's the efficiency of supply chain. It's getting those people encouraged turning up to work. It's managing absenteeism. It's managing Omicron. It's all about supply. Now, there's a fair bit of finger pointing that's getting pointed at the government, and some of that is due because it's been a bit of a smozzle in regard to the RATS test, all this sort of stuff. But businesses have got to take a fair bit of ownership going forward, because it's going to be the business sector that gets us out of this mess ultimately over time. We can't wait for the government, but we do need to have some serious conversations on things such as water, natural resources, benefit dependency, competition. The inquiry into supermarkets, great. It's the appetizer. Let's get into the construction sector. Education, as pointed out by the OECD. Infrastructure, light rail, all these sort of things. Is that project, the $15 billion project, is that really the best value for money in regard to what you should be prioritising in Auckland? I suspect the answer is no. Finally, I'm watching what I call a whole lot of fights of 2022. Fight one is Omicron, the boxing match. If you think about a boxing match, it's sort of 12 to 15 rounds. It feels like we're in about round 8, maybe round 9. So we're over halfway, but we've still got a wee way to go. Can we pivot from demand to supply? Demand is 400 metres of that 1,500 metre race. It's how consistently you run over the 4 laps, as opposed to the sugar candy first lap that ultimately determines where you're going to end up. The big focus of policymakers has been sugar candy and macroeconomics. Now the focus is all about microeconomics, same with the firm. If you forget about the economic environment, think about putting on those micro levers that are going to make you go on the top part of the K as opposed to the other part of the K. Share of the economic pie, that pendulum shift that I think we're starting to see away from owners of capital towards the workers. I think that is a tectonic shift to keep an eye on going forward. I'm a big believer in the long game versus the short game. In fact, I think short-termism needs stamped out. And the sooner we start to see a longer election cycle, et cetera, and see firms really buying into the long game and what's called stakeholder capitalism as opposed to the shareholder variable, the better. Inflation's the pop variable. Central banks have got a job to do, and it's going to come down to a battle of wills here between asset prices versus inflation. Yet taming inflation is not growth or asset price friendly. And it's going to take some pretty big calls. Wealth creation, induced spending versus interest rates. So think about that bucket list with the F. Yeah, a lot of money that's still floating around the New Zealand economy, and those baby boomers are going to deploy that cash. It's going to make the Reserve Bank's job tougher on the other side. Fundamentals versus sentiment, particularly in regard to that property market. Fundamentals are saying the market's going to go through an adjustment. Sentiment on the ground still seems to be, no, that can't take place. And then we've got a battle between fiscal policy versus monetary policy. Yeah, the more money the government spends over the next 2 years, the more difficult they're going to make it for the Reserve Bank to contain inflation. Yeah, the OECD came out and said, slow up the pace of spending growth. In all honesty, I don't think that's going to take place. And then we've got Auckland housing versus the regions. You know, I think we've got a lot more social housing problems across New Zealand is actually in the regions. It's not within Auckland. You know, Auckland's population growth in the last 12 months has shrunk, and building consents are 20,000. You know, there is a lot of townhouses, apartments that are going to hit the Auckland market in the next 12 to 24 months. Watch that market. So I'll wrap it up there, Mark. We can get into some questions.
Sorry. Hey, Cam, thank you so much. Very interesting. And it feels a little bit like the golden years might be over for a while for some. Just looking at interest rates in particular. So we've got the US, like they're around 7, I think you said. Australia's around 3.5, and we're 5.9. What's Australia done differently to us to pull theirs back and keep it relatively low?
Well, they haven't had the construction boom that we've had, and they don't have the same sort of acute worker shortages that are coming through, which is manifesting in wages. Yeah, if you ever look at within New Zealand, there's a whole lot of demand-induced contributors to inflation. But there's also other factors that have accelerated it, like some of the government policy in regard to the rental market, healthy homes, these sort of things. Now, we need to have done this. The healthy home stuff, I think, has actually been good.
Yeah.
There's a cost to pay on the other side.
Yeah. Insurance
costs across New Zealand have been absolutely surging as well. I can tell you that because I live in Wellington, and the bill each year goes up by about 15%. Yeah, some of those, what you'll call one-offs, are becoming a lot more consistently one-off. But but short story is that we've got greater excess demand here than what they've got in Australia.
Okay. To your point on crime, and I think everyone will be aware that Cheryl and I have worked extensively on issues advocating for more support for crime, for police to combat crime. We've all seen increases in crime across our precincts. It's an Auckland problem. It's a New Zealand problem. And there's a certain amount of irony that, the Labor government's kind of poured the petrol on the flames of divide between rich and poor for a whole lot of reasons, right? Sort of COVID obviously is a significant part. And my concern is that some of these things are systemic, and they're going to take a generation or two to fix if we start fixing them today. Do you think we're heading towards a sort of a society where we're going to end up like sort of Brazil or more like South Africa, where there's going to be, parts where gated communities, and we're going to have the haves and the have-nots? I think that's a real risk for New Zealand, because I'm not seeing a lot of government policy which is actually having effect at grassroots level and fixing some of those root causes. Any thoughts on that?
I hope not. But
Yeah.
if I have a look at what we've got at the moment in New Zealand, because we've got so many problems on the social side of the ledger, and some of them are going to turn into systemic problems. So if you ever look at regular school attendance, now regular school attendance for Pacifica kids, yeah, you got to be there 90% of the time. 45% of Maori Pacifica kids regularly attend school. Now that's a bomb in regard to what's going to go off in 10, 20, 30 years. So you talk about systemic problems on the ground, that sort of thing is the feeder system.
Yeah.
That sort of thing, when kids are not turning up to school, is the gateway into the gangs. And some of the sort of stuff at the moment just looks like it's being glorified. Now, you're not going to fix the education system unless you fix the housing market. Everything's intertwined here. And what we've seen for a long time is that typically one political party is really strong on the economy and they tend to be light on the social ledger. And another political party tends to be really strong on the social ledger, but they're weak on the economy. You know, what we need to see is greater balance between both those sides of the ledger. And I don't see any political party out there at the moment really grasping that.
Yeah.
You know, driving a sense of balance. But we've got a healthy economy headline, but if you look at you strip it back, it's very fractured. We've got a very unhealthy, divide opening up between the haves and the have-nots. And that becomes ultimately an unhealthy economy.
I think we're certainly seeing signs of that, certainly, from what we're seeing on the streets. And just to take that a step further, so we've got a situation now where Auckland is a bit of population decline, people moving to the regions. Do you think there's a risk, fast forwarding to 2023, it's an election campaign going on, the Nats and ACT get together, they are successful in taking back power, and they decide, right, we need a bit of a sugar hit for the economy, let's open up to mass immigration once again to get property prices back up and make everyone, to keep that momentum going. Do you think that's a risk that they would do?
Well, we haven't. You've got to have a look at what drives migration. And a lot of the migration is actually beyond our control. You can have a target and you can tweak, the ease by which can people come into the country. But one of the big driving variables of migration is just trans-Tasman flows. Now those flows can go from anything from 0 to minus 30,000. The best we do is that we get it down to 0, which we've had for the past number of years. When the New Zealand economy tends to be suffering, then it'll go up towards 30,000. And here's a scenario that worries me at the moment. The Reserve Bank, in order to get inflation under control, needs to turn the construction cycle. What normally takes place when the construction cycle turns, a whole lot of tradies jump ship and they go to Australia. And then all of a sudden we're back into that cycle where we go from overbuilding to underbuilding again. Yeah.
Because looking back, going back to Helen Clark's years, where there was a big the so-called brain drain to Australia and traders, etc. Then John Key campaigned on reversing the brain drain to reverse immigration back into New Zealand, and that over a period of time, we had a net gain, I think, for a while from Australia. But then now it seems to be COVID is a very sort of murky period of time in our history. It's very hard to read what really is happening. But I think there might be a risk that once we get back to some kind of international border normality, that that might be a new going flooding back to Australia to help them with their boom.
Well, it's not just that. Look, the glass half full was that New Zealand has got some pretty nice attributes in regard to hospitalisation rates. So this thing has not battered the health side of New Zealand like it has around the globe. So a lot of people are going to find out, look, New Zealand is the place to be. The flip side to this is that you flick on turn on the TV, and what do you see? You see everybody globally going to sporting events.
Yeah.
I think there's a whole lot of people in their 20s that are literally, chasing at the bit to go overseas. They're the old OEs that have been temporarily parked. But we're going to have some real hard discussions over the coming few years as we enter those trade-offs between the economy, mobility, and health. And at the moment, health is in the driving seat. Now, we cannot remain the hobbit or the nation protected by a moat indefinitely. We're going to need to reconnect with around the globe. If we do not reconnect with around the globe, people will bail.
And one question just come in, Cam, on the chat. So on the banks, are they playing silly buggers with their lending restrictions in terms of assessing expenditure to get a break in the legislation, or is the legislation poorly drafted?
The legislation is poorly drafted.
Cool.
Yeah, so what the banks now need to do is provide an evidential trail. So putting you through the magical sort of black box in regard to, just some basic Excel or algorithms in regard to whether you can afford a loan no longer cuts the mustard. But they've got to provide an evidentiary trail. Now, the banks warned the politicians and the policymakers pre-Christmas this would be the impact of this thing. There was a great quote one banker came out with, I think it was pre-Christmas, said, which part of our submission did you not read? Yeah, it's a piece of legislation that was targeting Auckland loan sharks. And to be fair, I think it needed to go further and look at the motor vehicle industry as well. But your banks are not in the business of irresponsible lending in regard to housing. If you ever look at non-performing loans across the banking sector, 0.2% of housing loans are in the non-performing category. It is ridiculously low. So there are, the finger here needs pointed very clearly at the policymakers and those that drafted the legislation, because they were told this would be the impact and they just ignored it.
They knew best. So they may have gone for the nuclear option where something a bit more eloquent could have been required. That's it from me, Cam. I know we're running out of time. Cheryl, do you have any questions? Hand over to you.
Thank you. Thanks, Mark, for hosting us, and thanks, Cameron, again. Your wisdom is always amazing in terms of big picture thinking. I just have two questions. The one was from one of the people on the chat about climate change. You've ranked it number 7 on your Mood of the Nation, and given the scale, complexity, and importance of solving the climate issues, doesn't it worry you that it's only number 7 on the list? That was the one question. And my question is, what role do you think the future mayor of Auckland can play, if any?
Right, so if we look at climate change for a start, given the sense of urgency around climate change, I would have thought climate change, sorry, can you hear me? Sorry, my video's gone off.
That's right. You can hear. Yep.
Yep. I would have thought myself that climate change would have been higher on that pecking order in regard to households' concerns. But I guess if you look at the other variables on that pecking order, there's some pretty big issues, and for appropriate reasons. Like housing is an obvious one. Healthcare in a Omicron COVID world, cost of living. Okay? Inflation's a thief that turns up and steals everybody's money. It makes people poorer. Your dollar doesn't go as far. So it's natural, I think, to see a lot of those other variables that are up there. I don't think it means climate is not a concern. It's just being usurped by a whole lot of other variables in the near term. In regard to the Auckland mayor, it doesn't matter whether you're the Auckland mayor or whether you're any mayor or whether you're a politician around the country. There needs to be some pretty big pivots, shifts in regard to thinking in regard to where we are going. The old way of thinking, I no longer thinks cuts the mustard. I think we need a lot more of a disruptor within that role, who's prepared to put a lot more blue sky thinking on the table. And that's just, I'll go back to one of those earlier slides that I had about disruption. Disruption is the name of the game on a whole lot of levels. Change is the new normal. And we need to shake the tree on a whole lot of levels and get people in key positions that are prepared to shake the tree.
Thank you, Cameron. I mean, you know, as Mark said earlier, we certainly share your concerns when it comes to crime, and I think between several of us, we've come to the conclusion that unless there's some big shaking of the tree at government levels, that cannot be solved locally.
Yeah. I think also that our electoral system isn't really conducive for tree shaking. You know, democracy, people want to get in and stay in. Yeah. Hey, Cam, thank you so much for this. Thank you for that too, Cheryl. We're very, very grateful as ever. For those that would like to review this later, we'll have it on online at some stage. We'll send out a link for that. But Cam, thank you so much. We're very, very grateful, and we will do this again in the not too distant future.
All the best. Apologies for my camera suddenly going off. I don't know what's going on.
No worries at all. Okay, Cam. See you all. Take care.
That.
Thank you.